Very
Brendan.
good.
Yeah,
Chris,
always
maybe you
good.
want to just introduce yourself for those that don't know you. We've met obviously and talked over the last months, but I think it would be good for people just to understand a little bit about your background and the company, and then we'll get into it.
Yeah, I think that's fair. I've done a number of these on the Davos side of things. This is my first time involved in the COP side event, so I think it is. There are probably a number of people in the audience who don't know me. So for those of you who don't, my name's Chris Richardson. I'm the CEO and a general partner at IDAP Global. The easiest way to describe what we do is that we're effectively a small to mid-market private enterprise investment bank, backed out of the UK. Uh, Primarily, the reason we exist is because of the advent of technology in the securities markets that enabled a niche to let us really do things in the mid and smaller markets that are uh, if not impossible, very close to impossible for large investment banks. And so we work with financing and advisory to really entrepreneurs around the world who are not your traditional technology venture backable startups, and also not giant enterprises that can pick up the phone and call Goldman, but who often have tremendous success in their niche and some opportunity to take their business to the next level, and we help them get there. So that's us in a nutshell.
Fantastic. So let's talk about impact because I think that's really the thing that you wanted to get across. And the first thing I suppose for a lot of people is how would you define the difference between impact finance and best practice ESG governance reporting requirements? What would you say are the biggest differences?
Yeah, that's a good question. I think. Yeah. So I want to talk more about the impact side of things because I think there's a lot to unpack there. But from my perspective, and I know this will probably ruffle some feathers, but uh, ESG is really just some bureaucratic nonsense. Like it fundamentally doesn't mean anything and doesn't matter. Now that said, the governance and good governance of a company is obviously important. That's almost tautological. Like you can't have a good company without good governance. And the E and the S part, the environment and sustainability parts of ESG, clearly anybody involved in environment or sustainability has an eye towards impact, at least in those particular areas. But for example, just because you construct a building to be fully LEEDs compliant, so that's a great ESG thing to have done. But does it have any impact? Is that really an impactful thing? Maybe kind of on the edge, but I don't think that's what people mean when they say impact. So I'd rather talk more about how do we really have impact and what does impact finance look like. And I think that's interesting too, because it's such a large bucket. I mean, finance and impact, each of those terms are like, what does that mean? They cover so much stuff. And I think one of the mistakes that people make when they start getting in these conversations is misunderstanding like where the dividing lines between different sorts of finance are, because there's a big difference between a philanthropic financing effort and an investment effort designed to generate profit. And even in the world of investments designed to generate profit, there's a big difference between a long-term cash flow generating above average market rate return stable investment and trying to hit the ball out of the park and find the next unicorn, right? The risk reward ratio can be very different, and all of these things apply just as well in the world of impact as they do in any other area of finance. So
And I think timing also has an impact on some of that too, right? I mean, wouldn't you say philanthropy typically has a longer horizon for its return than equity investing, or would you say that's not entirely true?
uh, perhaps in the sort of the common vernacular usage of those terms, it does. But I think in the real world, no. There are many investors who invest for profit for the very long term. I mean, Warren Buffett and Berkshire Hathaway are sort of fairly famous for, we don't even
And
look at our
hopefully your
investments
pension
except once
fund
every
as well,
five
right?
years. Yeah, exactly. And pension funds are a great example. So they need not be short term. But of course, from a management perspective, you want to be very short term focused. You need to have a 5, 10, or if we're in Japan, 300-year plan. But you also need to look, daily, weekly, monthly, quarterly. Are we on track towards that plan? Are the numbers working? Uh, but from an investment perspective, sure, you can be day trading futures, and that's a different investment horizon than investing into a 100-year return where you want stability. And again, all these things apply just as much to anything that we're going to call impact as they do in every other aspect of finance. So let's break that down. Let's talk about impact a little bit. Um, COP is obviously very much climate focused, and climate change is undeniably something that is happening. Now, the extent to which it's man-made, the extent to which it's bad, the extent to which it's a survival question for our species, people can debate these things, but you can't debate that it's happening. You can't look at the last 400 years of temperature and say, oh yeah, we're totally the same as we were 200 years ago, and that's totally the same as it was 200 years before that. It is definitely happening. And the extent of that matters depends a lot on what the world looks like. And today, what the world looks like is a lot of people have gotten a lot wealthier, and they're living in areas they didn't used to live that are much more susceptible to climate change, right? If in fact the water of the oceans rises 3 feet and you live in a beach in Florida, that's kind of an issue for you, right? And that's, of course, sort of a Western first world wealthy perspective on this. If you're a developing nation, if you're living in the middle or on the edge of arid land where the desert's encroaching upon you, there are all sorts of places where these are life and death questions for people, and the world's fully populated. So there's a lot of difficulty surrounding that. But that's just one aspect of impact. And while climate is important, and we also have to look at where else are we doing things that could be done better fundamentally to impact humanity. And there's actually an upcoming panel in this conference, which I think will be really, really exciting to see, which is about abundance and impact. And that's really where I come from and where our whole organization comes from, is the single best way to have impact across the board. Yes, you can focus on the kind of work that Bill Gates is doing, where we want to eliminate malaria. That's definitely impact, and it is definitely critically important, and somebody should be working on it, and that's great. But that's one very niche effort. And you can look at the work that Israel and China have done at stopping desert erosion, or in fact, reclaiming desert. And that's great and impactful and important. And somebody should be doing that, and we should be learning those lessons and applying them elsewhere. But from an investing perspective and from a finance perspective generally, I think it is, if not outright dangerous, certainly at least myopic to look at any one question that way. Because to be investing, you first have to look at the investment. And the reality is there just aren't that many opportunities in any one of those niches to enable it's solid investment with good returns for a large amount of capital. So from an impact investing perspective, you have to cast a wider net. You have to be more open to saying, okay, I want to find good investments that are having an impact regardless of the area, regardless of whether that's healthcare or disease or desertification or broadly climate change or green energy or carbon emissions, or you can go on and on and on and on and on. If you cast your net widely, then we are today, I believe, in a world where not only is it possible to invest and get decent returns, I strongly suspect that it's possible to invest and get above average returns. I actually think this is going to be one of the most exciting spaces to invest in if we cast that net broadly over the next, let's say, half century, at least 10, 20, 50 years. I think there's
Would
going
you
to be
see
a
that?
ton
Do
of
you see a
opportunity here.
difference potentially between equity investing in the company itself versus project financing? Because You can invest in
Mhm.
the company that owns the technology, develops it, has the intellectual property related to it. But there are also ways to invest in the actual projects that deploy those globally. So
Mhm.
you might have a company that is raising capital with a technology that has an impact, but that technology could be deployed globally with different investors in different geographies.
Mhm.
Do you see a difference between impact in project financing versus equity financing, or are they pretty similar?
I- There's a huge difference in investing in those two things. But
Of
again, I
course,
think it
but
has
in the
nothing
impact
to do
side.
with the fact. I think it doesn't matter. I think the fact that we've
Okay.
attached impact to it is largely irrelevant, right? If I'm going to be an equity investor that's investing for the long term in the future of a company, or if I'm going to be an equity investor that's investing for a huge upside at a giant risk reward ratio profile, like investing into a tech startup, that is a different class of investor than a typical project investor who's going to be looking at perhaps pure debt, perhaps debt equity hybrid, is going to be
Right,
looking at different time frames and guaranteed
right.
returns and guaranteed collateral. And if I choose to do that in an impact way, that doesn't, it's an orthogonal question. I mean, you can certainly do that, right? You can invest in solar energy. You can invest in an area that I know that's near and dear to your heart, the solar heating for industrial purposes, right? The so-called chip technology, where there's a ton of project opportunity out there. Um, and that's just a different class of investment than investing in equities, right? But the fact that it's
Right.
impact, I think, does not particularly matter. It matters from the impact side, but not from the investing side.
Okay. Yeah, very interesting. Now, some people would, I mean, I did a little research obviously before this call, and it's very, depending on where you look, assets under management for impact kind of space finance is, over $1 trillion or whatever the case may be. And there's a lot of research that shows that investment funds that follow a healthy social, environmental, sustainability policy, in addition to seeking financial returns, outperform the ones who typically ignore that. What would you say to that? Why isn't that the
Uh,
norm then?
uh, well, those are two different questions. So the first thing I would say to that is that does appear to be true. As you say, there's a ton of research out there on that, largely from think tanks, but also from very respected universities like Harvard. Uh, However, outperforming other funds that all underperform the market doesn't say anything particularly good, right? It's been known for a long time that managed funds very rarely exceed market returns. And that's why we have index funds, because it's hard. It's hard to make a long-term return that outpaces just the general market. And if you are, as many people in this audience are, a private investor who looks to control your own wealth on a larger scale and is looking for outsized returns, of course, you're going to have some of your money in all of these things, but really your baseline is above whatever the asset class is, right? You're not going to invest in a real estate deal that's going to, you think is going to return the real estate average. And so you're not going to invest in any old fund just because it happens to be an impact fund. And therefore, when the market's getting 9% and the average fund is getting 7.5 and the impact funds are getting 7.7, I'm making those numbers up, by the way, but you get the
Yeah.
idea. You're not going to aim for the 7.7 just because it has impact on the name. You're going to go try and find somebody to beat the 9. And then you're going to try and find impact if it's something you care about, which I think, in this audience, we can safely say most people do. And they should, because as I said at the beginning, I think we are entering an era where, broadly speaking, impact investing is going to outperform other classes of investing. And let me tell you why. So, if we look at the trajectory of, well, I'm very tempted to go on a long digression about how all of modern economists misunderstand the basics of economics, but we'll avoid that for now. Let's just take it as given that in the near term, and I don't know if the near term is 2 years or 10 years or 20 years, but in the relatively near term, AI and robotics are going to cause a lot of displacement of people in jobs. Now, there are many people who fear that, but I think that fear is really, really misplaced. And it's misplaced for two reasons. One, because we've had lots of technological innovation over the last several hundred years. And while it does cause short-term disruption, it has always been net positive, and I see no reason to see this differently. And two, and more importantly, we're already starting to see the kernel of what that transition is going to look like and what the world will look like afterwards. And what I believe it's going to look like is as everything becomes automated, everything that can be becomes artificially intelligently driven, that by definition is going to be a race to the bottom in terms of pricing. When you all you're concerned with is the price of commodities, you don't have any variable labor cost, and it's all automated, then it's going to be how do we get lower and lower margin, higher and higher in volume, cheaper and cheaper and cheaper, more competitive, and that's great. That means everybody gets more competitive goods at a lower price. But what that means is we as humans then have more disposable income. And what we will choose to do with that income, almost certainly, again, because we're already seeing this, is choose to spend it on other humans. So you'll see that in the 25-year-old now fresh and local grocery movement, right? So we're at a point where the world food supply is more food than all the humans need to consume. Now, there are issues and there are starving people, but those are largely political issues. The actual quantity is more than sufficient. And people are willing to pay extra to get fresh and local crops from their backyard, which means from human farmers in their backyard. And you're going to see as people watch more and more TikToks, listen to music more and more on Spotify, that they're willing to pay more for the local artist that actually plays at their local pub. And
Right.
that, I think, is a future direction of humanity, right? I'll give you a very specific example. I grew up in Michigan. Uh, and when I left Michigan a quarter century ago, there were 12 wet plasterers left in the state. It was almost an entirely lost art to be able to do the fancy cornices and the sort of wet plaster work that you would see in old school buildings. Today, there are nearly 300, right? That craftsmanship is reviving because people are willing to pay for the human element, the local element. Now, that is, I believe, unquestionably the direction of economics at a global scale. I don't think we can stop robotics. I don't think we can stop AI. And the more and more that commoditizes everything, the more and more local and human is going to have high value. So the other half of this equation is what's actually happening with the humans. And if you look at the last 200 years of the Industrial Revolution, we're all healthier, we're all living longer, we're all unimaginably wealthier than the greatest of kings from a few centuries ago, if you're even remotely middle class today. And yet there's tremendous psychological dysfunction, right? You see statistics like 60% of youth under the age of 18 are diagnosed with anxiety. Like these are crazy, crazy, crazy numbers. And it's not just, I mean, you can start pointing at little things, right? You could say, well, it's overdiagnosis, or well, we have more codes in the handbook, so we can put people in more buckets. And there's some truth to that, but it's not 8x what it was when you and I were born, right? That's just crazy. There is actually something changing. And I think that change is being driven by this sort of the lack of what's coming. And we're going to recover a lot of that. And people are going to become much more spiritually and emotionally connected and happy as the world evolves in the direction that it must with this abundance, with you becoming more connected to your local community, with you becoming more connected to a job that has value to the people around you where you can sell things locally. So what does that all have to do with impact investing? One of the things that we've noticed in particular as we work with mid-sized and smaller enterprises around the world is that the companies that care about that put their employees first, that put people first, are the ones that tend to have the best returns. And that's today. It's not even today. It's kind of historical. Like here's a funny sort of business class question, right? I don't know this may no longer be true. It may have changed, I don't know, 2008, 2010, but as of 2005, what company do you think had created the most millionaires in the world?
Probably Microsoft. I don't know. Tell me, tech company.
Microsoft would be a very good guess. The answer is UPS. For those of you who don't know who are around the world, UPS is a private parcel carrier in the United States, actually globally now, kind of a DHL competitor for the global stage.
Right.
They had created more millionaires because they care about their employees and they compensate their employees in such a way that many, many, many of their managers over the decades became millionaires just by being a manager in that company. And so there are lots of different ways that enterprises can be local, can be human focused, can care about their companies. And that has more impact than any single individual niche impact class, the environment or health or whatever. It's the solution to all of them. And I am sensitive that we're coming up on the top of the hour here. We're going to have to hand this off shortly. So I will turn it over and give you an opportunity to ask one last question. But before I do that, I do want to say this is not all just hypothetical. We're in pretty serious discussions with a number of partners about launching a fund to target this globally in the next 6 months or so. And so I'd say to the audience, anybody to whom this sounds appealing, to who shares this belief that investing in humanity is not only the way to have the most impact, but also the way to drive outsized investment returns, reach out to me. I'm easy to get to. I think I'm all over the websites here, but you can reach me at cwr@idap.uk. That's probably the shortest thing you could type in to get to me. Find me on LinkedIn, find me on the socials, whatever, and let me know if you're interested. We're not doing a raise today, but we're very, very seriously considering that. And if you'd like to participate, I'd love to hear from you. I'd love to get your feedback. I'd love to talk more about it, and definitely reach out to me. So with that, any last questions, Brendan, before we hand it over to the next?
Yeah, but I was going to say, besides reaching out to you, what advice would you give CEOs of companies that are, particularly the smaller companies, looking to raise capital? Obviously reaching out to you is a good thing to do. But what about their approach towards investors? Would you say, what's the tip you would give them that really will get the attention? I mean, how do they show that this is traditionally or is the way to give a preferred return as well?
To be completely honest, for the size of companies that we're talking about, and most of the companies that we work with, this is again one of those questions where the fact that its impact is kind of irrelevant.
Right.
In our experience, most entrepreneurs at this stage have no idea how to talk to investors. They don't even know what the first words out of their mouth should be. They don't know how to approach investors. They don't know what kind of investment options are available to them. They just need capital. And so they go to their bank and the bank says no, and they know they can't call Goldman, so they kind of don't know what to do, and they start calling friends and family. So I guess if anybody's listening and is in that position, the most important thing for you to do is to figure out why your investors care. Like this comes out of the venture capital world, right? But your story has to build and it has to start really, really quick and really, really small. In the VC world, we call it the elevator pitch, right?
Right.
You find the perfect investor, you get stuck in the elevator with them, and you're going up, and you have 3 floors, 4 floors before he's going to get out to pitch your idea. You need to be able to distill your value proposition down to that, to 30 seconds, a minute at most. And then you can build from there to a larger story, to a memo, to an investor deck, to presentations. But start with boil the ocean, have your ideas, figure out what you're doing, but get it down to as crisp of a message as you can, and that's where you start.
That's really interesting. I think that's obviously good advice anyway, whether it's impact or not, in terms
100%.
of raising capital. But I think what you're saying is include the impact that you will have in your elevator pitch so that you get the attention of the people that you are trying to address, and distill down what you're trying to achieve, in the marketplace.
So yes and no. It's actually, I'm glad you said that, because that's one of the things that people often misunderstand, right? Is if you're working in a company where you're focused on impact, then that's near and dear to your heart. And there will be some investors who are impact investors, and it's near and dear to their heart. But not all investors will be.
Right.
And you need to make sure your message is tailored to the investor to whom you're speaking. So you should not limit yourself from an entrepreneurial perspective only to investors who invest in impact. You should find your best source of capital, right? The lowest cost of capital, the best partner for you in the long term, who could all the reasons that you find different investors. And if that person isn't an impact investor and you go blathering on about impact, they might just walk away. So
Right.
the impact's important to you and it's important to the world in terms of the actual impact, but you have to hone your message to your audience. And so
Right.
speak about impact when you're talking to impact investors, but don't limit yourself to that and have a message that doesn't include that as well.
So if you're talking to an investor that doesn't care so much about impact, take their money and go and have the impact anyway.
If their money is good and they're a good investor for other reasons, 100%, 100%. Why not have the impact? Why do you care that they care about impact?
Exactly.
You care about impact, right?
Exactly.
Yeah.
Well, this has been fascinating. Chris, I hope that you do start that fund, because there's definitely a need for this. And I think it's been very clear. And I'm glad that you've clarified some of these differences, because I think there's been typically quite a bit of confusion. But I think impact really goes a lot further than ESG, as you clearly said.
Oh, yeah.
And it's all, the one is a reporting, as you said, a mechanism for administrative or regulatory requirements. The other is more about the person and their soul and what they're trying to achieve, besides making
That's
money.
right. Absolutely. Not besides, in addition to.
In addition, yes. In addition, yes, that's the point. Very good.